Most investors think that the market is rising because companies are growing. They believe price reflects value. They assume index funds are safe. But what if the entire foundation of the belief is flawed? What if the same thing that made markets rise is exactly what could cause them to fall? And I mean fall hard, say 50% or more? So in this video here, I want to unpack why the $52 trillion bomb that no one's prepared to really talk about could be getting ready to pop, and what that might mean for you. That's worth talking about. All right, my friends, so I want to take a minute, share some thoughts in reference to just some recent market issues that definitely need to be discussed, because as of right now, our current administration, as well as every administration, is all centered around the stock market. And wherever the stock market goes, that's being used as a measurement or a gauge for the health of our economy. And so clearly it cannot go up forever without there being some type of correction. And so the question is, and what I want to talk about in this video here, is how that could be the reason why there's some type of systemic event that's worth touching on. So in this video here, I want to basically lay some thoughts around three premises here. How passive income might have already broken the stock market, the tipping point that could flip inflows to outflows, and last, the probability of a 50% or more crash reinvent the whole concept of investing, and why a lot of sophisticated investors aren't sleeping on this idea itself. But as always, if you guys want to hear more of these little quick takes, definitely drop a comment down below. Let me know your thoughts on this subject matter as I lay it out here, and also hit that thumbs up button and subscribe if you want more of these little quick takes. But how passive investing is quietly taking over. So if you just look at the charts of the S&P since, say, the GFC, for example, it's practically going vertical. Yes, we've had some dips here and there, 2018, 2020, because of the whole, COVID situation. But the buy and hold has worked like magic for decades. But here's the twist. When you ask retail investors why the market went up, they'll tell you because the companies are doing better. And that's not really a good case to be betting on. So according to a lot of sophisticated investors, such as the Ray Dalios, the Tim Drapers of the world, they say that the real reason the S&P hit all-time highs isn't fundamentals, it's the basic mechanics, a lot of things that we don't tend to look at. So it's the passive investing model that has been put in place over the last several decades. So when you contribute to your 401k or an index fund, you're not doing your research. You're not looking at the PE ratios or balance sheets. You're just auto buying exposure to these markets, usually through some type of S&P fund. So that sounds smart because it's low cost, it's time efficient, doesn't really require much effort on your part as an investor. But if everyone starts doing this, you shift the market from discretionary buying, which is more active, all the way to indiscriminate buying, which is more passive. So that means price moves aren't based on analysis, they're based on flows. So now think this through. If passive funds are taking over, then we don't have buyers asking, is this a good deal? Is this the right timing? All types of things that investors used to be concerned with. We just have money blindly chasing momentum. The worst part is this changes how people think. So investors no longer assess value. They assume price equals value, and that's where things get dangerous. So let's, for example, take this pen. If it goes from $1 to $1,000, no one believes it is worth more unless it's made of gold. But when the S&P, for example, rises, everyone just nods and says, oh, must be worth something. And see, that's the problem. False perception leads to distorted reality in most cases. The next thing worth touching on is the point that no one really sees coming. So what happens when those passive inflows become outflows? See, that's the $52 trillion question. And that number, that's the market cap of the S&P 500. So if passive funds are fueling indiscriminate buying on the way up, they'll fuel indiscriminate selling on the way down as well. So no analysis, no floor, just pure X's. A continuous spiral that we haven't seen before. And so there's two main culprits that could be the reason for that. You got one, which is demographics. So you have the baby boomers that are retiring and they're drawing funds out instead of contributing. Then you have the labor market shifts, especially when it comes to unemployment. Because if people don't work, they don't think about saving. Nevertheless, invest. So historically, passive flows rise when employment is high. So you got more paychecks, more 401k contributions. But when the joblessness rises, inflows slow down or stop altogether. So here's how the sophisticated investors usually think. They've probably modeled this out, and they believe that the tipping point on average could be, say, 5 to 6% of the unemployment rate, which could be enough to kick this off. And above that, we shift into net outflows from passive funds. And if that happens, there's nothing to catch the fall at all, because the active investors, the ones who used to buy the dip based on fundamentals, have been squeezed out a long time ago. Now here's where it gets wild. These sophisticated investors believe that AI could accelerate this shift, and I mean fast, because AI in of itself, or the advancement of technology, can be deflationary. And so the bigger the tech boom, especially when it comes to automation, that means more people will get laid off, and that means less people to actually invest in the markets. And so they're not alone in this. So in 2025, Anthropic CEO predicted that AI could wipe out 50% of entry-level white-collar jobs within just 5 years. Other experts are even more aggressive, forecasting somewhere between 10 to say 20% unemployment in in that same time frame. And so that's not science fiction, to say the least. That's a direct pipeline into this doom loop, which could be good for those that invest in it and bad for those that don't see it coming. And so what happens during doom loops, you have more job losses, fewer contributions, you have passive outflows, the S&P tanks, investors start to then panic, then you have way more withdrawals, and then that same loop repeats itself. And so the scary part is most people still think that the Fed can actually fix this. Drop rates, stimmy checks, save the day. It's not going to work the same way like it did last time. But even the Fed can't print confidence back into the system that's strategically and structurally broken. And the last point worth touching on is how low could the S&P actually go? So now let's be clear. This is not a prediction. I'm not trying to spread FUD or bad news and trying to ruin your day at all. But this video here is about being realistic because nothing can go up forever. There must be a day of correction. And when every single index fund, every single market that we know is all predicated on the illusion of confidence because it must go up, making people feel wealthier, at some time it must correct. I'm sure you can agree with that one. And so it's not about panic. It's about risk awareness. And of course, being able to soundly calculate whatever your risk tolerance is. So because making long-term investment decisions, you should understand the tail risk. Even the sophisticated investors, they're still long in this, but they're hedging strategically because they know something's coming. So let's ask, if this time bomb explodes, how bad could it get? So let's start with the valuation part. So historically, the decades where the S&P saw strong real returns, it was the 50s, the 80s, the 90s, and 2010s. They all started with PE ratios of under 20. The only decade that started above 20, which was the 2000s, we know how that ended. Where do we start this decade? Above 20, of course. So even if this doesn't end in a collapse, history says that odds of a low return decade are already high. So even if it doesn't collapse, there's going to be some type of correction. And the correction could spiral out of control, confidence could be lost, and then people start panicking, and that doom loop I talked about earlier kicks in regardless. And so as for a short-term crash, very probable. So those sophisticated investors, those that think outside the box, they're predicting probably 50% drop at best in the S&P, which is very realistic. And disturbingly, that was very optimistic, might I add. And so at the end of the day, I'm not here to tell you what to do with your portfolio. I'm not predicting a crash, just telling you about what is more than likely probable. I'm just telling you what sophisticated investors such as the Tim Drapers and all those individuals that have been warning us forever about how and what could happen and what some of the things that they're probably whispering about behind closed doors. Because when everyone is blindly buying, nobody's prepared for what's happening when they all try to sell. And so once again, sharing these thoughts, sharing the probabilities of what could come, probable scenarios, the reasons why, of course, but more importantly, to try to make you more aware of what's happening. And if you know something's coming, hopefully you're preparing in advance. And of course, my motto is always to get your weight up, because majority of people who are going to experience the most pain are solely dependent upon that 60-40 model of stocks and bonds. There's a time for that. That time, in my opinion, has passed a long time ago because monetary policy has distorted reality, because we can't tell what is real and what's not because everything has been rigged. But we can tell what is real when it comes to 24 karat gold and silver. Those are two monetary mediums that will not fail you because they haven't prior to. So once again, take a minute, share your thoughts on the subject matter. If you guys want to get some outside the box strategies and some things that I would encourage you to look into, of course, one way as always is to get 24 karat gold notes to get you a bundle of the most affordable gold I think a person can hold, whether it be for selling or for trading or for just for bartering sake. You can go to buygoldnotes.com, links in the description. And of course, if you want to join an active community of stackers in the silver world, then I want to encourage you to join My Silver Team, links in the description, where you can automate your silver accumulation on a monthly basis and be rewarded for helping other people do the same. Feel free to check that out, mysilverteam.com, links in the description. But other than that, taking a minute, sharing with you some thoughts worth considering. Curious to hear what you guys think. If you found value, hit that thumbs up, drop a comment. Catch you guys later.